It's Tuesday, the 30th of July, 2024. Welcome to the Fast 5 Business News by Fear and Greed, where we give you the top 5 business stories you need to know in just 5 minutes. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, 5 stories, 5 minutes. Let's go. Story number 1. The banking regulator remains worried about the outlook for people repaying their home loans, telling lenders like the big 4 banks to maintain a 3 percentage point serviceability buffer.
That's the amount above the advertised rate that new borrowers must be able to afford to pay. If someone takes out a home loan on a 7% interest rate, the 3 percentage point serviceability buffer means banks will need to make sure those people can repay a 10% loan. The Australian Prudential Regulation Authority said in reaching its decision to maintain the relatively higher buffer, it took into account the uncertain interest rate and economic outlook, with high levels of household debt and inflation still above the Reserve Bank's target range, as well as ongoing geopolitical instability. Balancing these risks, at least the quality of new housing lending remains good. Arrears rates on mortgages and business lending also are relatively low. APRA also said credit growth for home loans is now below the long-term average. For business credit, it's slightly above historical norms.
Sean, given interest rates aren't actually expected to rise that much more, is 3 percentage points as a buffer too much?
Perhaps. It does make it harder for people to get a home loan, particularly those on lower incomes. And given the rate cycle is turning, it seems to make less sense now than perhaps a couple of years ago when rates were very low. Having said that, if the economy goes into recession, then lower income households could suffer most. Certainly, these tighter credit standards could help slow the housing market. Price growth is slowing, but auction clearance rates remain pretty good. Over the weekend, the preliminary clearance rate nationally was up 1 percentage point to 72.2%. Sydney led the way. Adelaide actually led the way. Sydney came in second. Melbourne was not too bad either. We'll know more about prospects for the housing market and whether the regulator has been too cautious in its mortgage serviceability buffer after tomorrow's inflation data is released.
All right, on to story number 2 now. And hospitality businesses failed at the fastest rate on record last financial year as rising food and energy prices and a pullback in consumer spending pushed cafes and restaurants to the wall.
Cafes, restaurants and small retailers registered disproportionate growth in insolvency appointments in the past year, according to a report in The Australian, as consumers were forced to pay more for essential items and they pulled back from discretionary purchases. Figures from the Australian Securities and Investments Commission shows the number of collapses in the sector jumped 50% to 1,667. Retail trade appointments jumped 42%, and total insolvencies were up 39% to just over 11,000. Now, that's a record number, though it is much more like pre-COVID numbers. Thanks to all the government handouts during the pandemic, insolvencies fell sharply in 2021 fiscal year to about 4,000, less than 5,000 the following year. Now they have surged. There's catch-up going on. ASIC also said there were 3.38 million businesses registered in Australia at the end of June, up from 1.18 million 12 years ago.
This next one's a bit alarming. Sean, story number 3, Australians are still dying at higher rates than before the pandemic, suggesting that COVID-19's lingering effects may be driving a sustained increase in death and disease.
Excess mortality, the increase above the expected toll had the pandemic not occurred, was 5% last year, according to the Actuaries Institute. The figure is significantly higher than the 1 to 2% excess seen in years of strong seasonal influenza epidemics, according to a report on Bloomberg. Australia has relatively high COVID vaccination rates, but many survivors have lingering ailments. For example, more than 4 years on, hospitals are still experiencing an unexpected increase in coronary artery disease. These findings in Australia support growing international evidence that COVID-19 has worsened health across populations, especially in the elderly and marginalised racial and ethnic minority groups.
Story number 4, Commonwealth Bank's share price closed at a record high of $134.90 yesterday, denying the naysayers who argue that the country's largest company is overvalued.
Almost all the major bank analysts think Commonwealth Bank's share price is too high and expect a correction, but investors aren't listening, and it seems overseas investors in particular aren't listening. The group's share price just keeps rising. It's up about 40% since October last year. The main reason the ASX 200 has performed so well recently. On top of that, investors have been receiving dividends. A couple of weeks ago, it became the largest company on the ASX. It's now $11 billion bigger than BHP, nearly twice the size of National Australia Bank.
Last one, story number 5, Deadpool and Wolverine looks to have reversed Marvel's box office slump, with the superhero sequel expected to have made about $200 million over the weekend.
And that was in the US. It was an all-time record for an R-rated movie. Marvel deployed 2 of its most popular characters following a couple of relative duds, and it was expected that Deadpool and Wolverine would collect another $238 million overseas for the 3 days. What's that, $438 million for 3 days? Not bad, given it cost only $320 million to make. Of course, it stars Hugh Jackman. 2 years ago, Marvel's Doctor Strange and the Multiverse of Madness made about the same amount on weekend one. Eventually sold about $1 billion worth of tickets. They're hoping Deadpool and Wolverine can do the same.
All right, there we go. The top 5 business stories in 5 minutes. Thank you, Sean.
Thank you, Michael.
It's Tuesday, the 30th of July, 2024. Remember to hit follow on the podcast, and in 5 minutes isn't enough, you can find our longer daily show called Fear and Greed, wherever you listen to podcasts, or at fearandgreed.com.au, which is also where you can sign up for our free weekly newsletter. It comes out tomorrow, so get onto that one today. I'm Michael Thompson, and that was the Fast 5 Business News by Fear and Greed. Have a great day.